one would suspect that they'll probably find some other way of injecting money into the system. But, indeed, if they are true to the word and they cut it on March 11th, which will coincide very closely with the reverse repo market being drained, one has to wonder what that is going to do to the system, this crisis, if you will, of credit, this slush fund that has been available not only to the banks to reliquify them, selling their treasuries that were valued at 50, 60 cents on the dollar, selling it at par or 100% face value. That money has to be paid back. And that money has to be paid back supposedly starting March 11th. Now, the loans are being made up until March 11th, which in theory means that you have a lag, if you will. If they're still getting loans up to March 11th, that would mean that 1 year from March 11th is when all hell would break loose.
In a recent discussion, Andy Schectman sheds light on concerning trends in the US economy, underlining a noticeable uptick in insider selling of shares alongside a heightened interest from sophisticated investors such as family offices. Notably, Schectman emphasizes the significance of March 11th, linking it to potential monetary policy shifts and the cessation of funding programs, which could have far-reaching implications for financial markets. He warns of the looming possibility of a banking crisis, stressing the need for vigilance in navigating the increasingly complex economic landscape. As uncertainties persist and market dynamics evolve, staying informed with our channel's comprehensive analysis and expert insights is essential for making informed decisions. Subscribe now and activate post notifications to stay ahead of the curve.
Aside from a tremendous amount of insider selling of shares, we're seeing interest on a very significant level in terms of sophisticated family offices, in terms of financial advisories, very, very large, wealthy clients. The volume is very tepid, but the size of some of the orders that we are doing and the frequency in which it's happening with certain groups of traders and investors that I would classify as being very sophisticated is strong. And it's interesting, most of the drive has come from family offices and financial advisories that are acquiescing to the wishes of the members of the family office and deviating from the traditional path that they have found themselves on. And so it's interesting to me that this is, I think, kind of telling, if you will. You always see the biggest money move ahead of the crowd, and it's not because they're more sophisticated because they have more money. It's that they associate in circles where information is more fluid and more relevant and more timely. And so I think that is a trend that is undeniable, at least in terms of Miles Franklin. And you and I have discussed this offline, but I guess I would call that a precursor to what we could expect, kind of like we're seeing Silver Eagle premiums ratchet up and up and up and up all of a sudden over the last couple of days. And I wonder, is that a precursor to what we can expect to see here soon? I mean, and every single time it's the Silver Eagle that leads the way. And we've seen 2 or 3 or 4 price increases, little by little, 5, 10, 15 cents at a pop over the last couple of days. So, little indications, if you will, that you look for some sort of a telltale of what's coming, and whether it be much larger orders by very, very sophisticated traders or seeing the Silver Eagle premium start to creep up. Maybe some people are starting to wake up after all, in what has really been a mystery to me, how quiet it has been in a world that seems a whole heck of a lot more concerning to me than anything I've seen over the last 3 years, and that includes being in the heart of a pandemic. One would suspect that they'll probably find some other way of injecting money into the system, but indeed, if they are true to the word and they cut it on March 11th, which will coincide very closely with the reverse repo market being drained, one has to wonder what that is going to do to the system, this crisis, if you will, of credit, this slush fund that has been available not only to the banks to reliquify them, selling their treasuries that were valued at 50, 60 cents on the dollar, selling it at par or 100% face value, that money has to be paid back. And that money has to be paid back supposedly starting March 11th. Now, the loans are being made up until March 11th, which in theory means that you have a lag, if you will. If they're still getting loans up to March 11th, that would mean that 1 year from March 11th is when all hell would break loose, because not all of the loans were made at the very beginning. In fact, many of the loans were made during this last few months, where they were able to borrow at 4.7% and then give it back to the Fed in a different window and get paid 5.3%. Just the complete and total lunacy. But yeah, if they're true to their word, which I guess at this point, it's very hard to believe anything that they say. And we've been saying this all along, that, you know, rates aren't going to go down, and at least not in the foreseeable future. They will lose all credibility if they do that. And inflation is here to stay. And, you know, just go out to dinner once and tell me that inflation is not really here. And it is here, and it's not going away. And it's, as far as I'm concerned, I mean, just look at the basics. How the heck do you pay for Medicare and Medicaid and Social Security and government military pensions on top of the $34 trillion debt obligation? How do you pay for all of these liabilities to the American public when the rest of the world are selling treasuries? Who's going to buy our bonds? Who's going to finance the ridiculous debt binge that the federal government is on? They're addicted to debt. Who's going to finance it? And let alone the nearly $10 trillion in 2-year treasuries. I think $8 trillion in 2-year treasuries that need to either be rolled over at higher rates now or paid off. Who's gonna do that? And how does that happen? And so I think inflation is here to stay and will only get worse. And so when you put it all together, we are running into some very dangerous times if indeed they do stop this, and they do stop the funding program. You're looking at a banking crisis, and it would be hard to believe that they'll let that happen in an election year where you'll start to see a run on the banks. But you know, indeed, I would say the likelihood of this happening closer to 2025 in March, because, you know, there are still banks that are taking advantage of this until March 11th, and those loans are good for 1 year. So don't expect something crazy to happen March 11th. I would say as we get into the following year, spring, the likelihood of some really big fireworks, I think, are fairly likely.
In the next discussion, Andy Schectman delves into the geopolitical shifts reshaping global finance, focusing on the emerging role of the Enbridge system in facilitating direct currency trades among nations, bypassing traditional channels like the SWIFT system. He underscores the significance of this development, particularly in light of countries like China divesting from US treasuries and opting for local currency settlements. Andy emphasizes the growing momentum among BRICS nations to trade in their respective currencies, potentially challenging the dominance of the petrodollar. Moreover, he discusses the trend of central banks increasingly reallocating reserves into gold rather than US treasuries, highlighting the long-term implications for global currency dynamics.
The Enbridge is certainly going to be a big part of it. We've been talking about the Enbridge for about a year now, which is a way for these countries to, and I'm glad you brought this up, because to me, this is a very important point. You know, the Enbridge is a bridge that allows these digital currencies, these nations' currencies, to trade with one another, sidestepping the SWIFT system, which is the way that the United States imposes, one of the ways they impose sanctions. And, you know, maybe I'm guilty as well of focusing too much on the Russian finance minister's proclamation that, hey, we're going to have a unified settlement currency that will be pegged to a basket of commodities. And maybe that will happen, right? But look at what's been happening, right? If you look at China as an example, at one point they had almost $3 trillion worth of our treasuries. They're down to 700 or 800 billion. It's still a lot, but they are shedding treasuries at a rapid rate, the lowest level they've had in 16, 17, 18 years. And the same thing is true of many of these BRICS nations that are no longer bidding for our treasuries. So when you think about it, we were told at the end of the August meeting that they would all go back, the finance ministers, to the drawing board, come back and present their findings for a common settlement currency. But in the meantime, everyone trade in their local currencies. And that is indeed what we are seeing, and more proclamations all throughout the BRICS nations, whether it be India, whether it be Egypt, Saudi Arabia, Iran, Russia. They're all trading with one another using local currencies. And the difference, the delineation here, when we talk about that particular move, right, trading outside the dollar in local currencies, well, we saw 20% of oil sales settle in other currencies this year. That's a big divergence. But as we continue to see this BRICS conglomerate grow, and there's another 35 countries that have formally applied and 20 that have expressed interest, and this mass adoption grows, and all of these countries agree to trade in local currencies. Remember, the petrodollar is not just the dollar being what oil is sold for. That's part of it. The other part was taking the excess and the reserves and putting it into U.S. treasuries. So number one, you start to chip away at the settlement status of the dollar, which is big deal, especially as we see more and more and more of these oil producing countries be part of the BRICS group, and all of these countries that produce the world's commodities as part of this group that always settled in dollars will now settle in local currencies. And instead of taking that excess, the excess currency that they would otherwise have just sitting there earning nothing, they would typically put it into U.S. treasuries, which are very liquid and very safe. Well, instead, what you're seeing is 2+ years, almost 3 years in a row, of the central banks, the people who know the playbook, not just the wealthiest, but the most well-informed, buying gold at levels the world's never seen. And now you're seeing all the exchanges being bled dry, a continuation of what we've been talking about for 3 years. What does that mean? That means they're selling treasuries, not rolling them over and reinvesting them, but instead buying gold. And look at this, look at how that's played out for the last 24 years. If you go back to 2000, gold has appreciated by 7.8% per year. The S&P, 7%. And the bond market, less than half of that. So you have no default risk, no counterparty risk. It's an asset that is not simultaneously someone else's liability. You have much less in the way of interest and inflation risk as it pertains to using gold instead of U.S. treasuries as the replacement for the reserve. So if they settle in other currencies and put the excess into gold, as it very much appears like they are doing, you will begin to rapidly, and I mean rapidly, chip away at the dollar hegemony.
In today's discussion, Andy Shechtman has provided critical insights into the economy, highlighting the increase in insider selling of shares and the growing interest from sophisticated investors like family offices. He emphasizes the significance of systems like Enbridge in facilitating direct currency trades between nations, potentially challenging the dominance of the US dollar. Shechtman also points out the trend of central banks reallocating reserves into gold rather than US treasuries, suggesting a potential erosion of the dollar's hegemony in global finance. These insights underscore the complexity of today's economic landscape and the need for adaptability. If you found this discussion valuable, remember to subscribe, like, and share your thoughts in the comments below. Your engagement helps us continue to provide insightful content. Thank you for watching.